If you are going to trade for a living, you do need a variety of different trading styles so that you can adapt to the market in front of you and still figure out a way to make money. So let's talk about what works well in all markets. And that is going to be something you've heard me talk a lot about, and that is selling puts. Now, you can sell puts in a variety of situations. And the reason it works is you are actually getting a stock at a discount. And I will help you identify what a fair price is when I get to the computer here in a minute so that you can look for a fair price on any quality stock at any time. So selling puts works in a variety of markets. Now, the counterpart to that, selling covered calls, that works well as well. The main thing on selling covered calls is it's the wheel strategy. You want to make sure that you are selling your stocks for the call away at a fair price. And I'll show you what's a fair price on the call away. But there's other types of trading as well. Have you ever heard of something called the buy right? Now, I have a great video on that. I will leave it at the end of this video. But the buy right is wonderful because you take a stock that's in a bullish mode and you buy 100 shares. Usually I do this on a Wednesday or a Thursday on a stock that is starting to push up, and then I immediately sell a covered call for the call away. And that usually creates this incredible return because you're getting the return of the premium from the covered call, and you usually get more because it's in a bullish mode. And then you're getting a little bit of stock appreciation for the call away. But the best part is you can actually get your hands back on that money and rinse and repeat the following week. Now let's talk about credit spreads and how they fit into the equation. Well, you have two types of credit spreads. You have put credit spreads. Those work best when a stock is pushing up because you don't want it to get to your sold put strike. And then you have call credit spreads. Those work best when a stock looks like it might be retreating soon because you don't want it to get to your sold call price. So if you do both of those together, that's an iron condor. So iron condors work best when a stock is moving sideways, and you can take a put credit spread that may be losing and actually apply to it a call credit spread to help insulate you a little bit more from any kind of drawdown. And finally, we have skips and leaps. Now, I've done a lot of videos on skips and leaps. Those definitely work best in a bullish market, and there's a specific time that you want to buy them. When a stock is at the bottom of its Bollinger Band or when it looks like it's a quality company that is just oversold. Now think about the recent dynamics that we've had with Meta and Netflix, and even we had the trigger the other day to go ahead and buy leaps on the NASDAQ when it hit the 50-day moving average. I'll show you that and I'll thoroughly go through that in another video. But those are the best times to deploy those strategies because you're basically buying a call option and then you are turning around and selling it when it starts to profit. Skips, usually you're looking at 3 to 9 months out, and then you're taking profit usually within a couple of weeks up to a couple of months. Now with leaps, those are longer term trades, and usually you're buying them at a strong level of support and you're holding on to them for quite some time. Now you can use your leaps once you've reached your leaps freedom day to start selling covered calls against it. That's the poor man's covered call. So there's such a variety of ways to trade, and if you're interested in all of this and you want to learn it step by step, you can join my community. I spend time with my community throughout the entire week. I'm in the community, I'm hosting calls, I'm helping to train. In fact, of all the different things that I've done recently, one of my proudest moments was when I saw this note from one of our members, Bruce. It really meant a lot to me. And he recognized the fact that I was available to all of my members, not just when the market's green and everything's great, but I feel like that my community needs me the most when things are red because they need to unwind trades that they got into that maybe they shouldn't have, or they're trying to figure out how to best manipulate a trade to save it. And I gave a lot of different strategies so that we could help them through those moments. Because really, though the market's red, it's an incredible opportunity if you have cash to the side to deploy into the market. If you don't, it's a little bit more painful, but a lot of times all you have to do is wait, especially if you have a quality company. Your stocks will eventually turn around and head back up. You know, when you're in the market, it's like taking 2 steps forward, 1 step back, 2 steps forward, 1 step back. But that done over and over and over again will lead to you making money. So for any of you out there that you were panicked this week and you felt like that the whole world was falling apart, I'm here to tell you it will be green again as long as it's quality. You want to make sure that you balance your portfolio that can withstand any kind of pull down downs. And if you have quality stocks as the bulk of what's in your portfolio, usually you can do pretty well. There's room for speculative stocks in all of our portfolios, but I just leave that as a small portion of my portfolio because when markets are under pressure, then those stocks that have yet to have a proven business model and they have yet to have 4 quarters in a row of GAAP profitability, those are the ones that are dropped like a hot potato. So I don't want any of you to be caught with having too much in any of those speculative plays. But believe me, some of those speculative plays, they grow up to be very incredible stocks. Think of Palantir. I was investing in Palantir when it was speculative. Now, I had a belief in their business model. I fully understood what they bring to the table, and I put a small amount of money at the time that now has grown to be a large amount of money. But it doesn't take a lot of money in speculative trade to make a lot of money. All right, let's jump into the computer and talk about all these different strategies, and let's get you ready for the week ahead. The first thing I want to go over with you is the Fear and Greed Index. This also is a great indicator that will help you best determine what strategies may work best when we are at different levels in the market. So being in extreme fear, typically this is a really good time to consider buying leaps and skips because you want to buy them when we're in extreme fear. And then when that dial goes all the way up to extreme greed, then you might want to consider getting rid of them. This is also a great time to sell puts because if you are put the shares when a stock is in extreme fear, then there's a lot of room for that stock to go up and you can enjoy the price appreciation when that happens. Now, when we're talking about credit spreads, you typically want to see that the market is in more of a neutral state. That does very well. Like let's say that you are going to do credit spreads on the Qs and you want to do both sides, the call credit side and the put credit side. That's an iron condor when you put them together. Ideally, you'd want the Qs to be trading sideways for that. Now, when we're getting up here into greed and extreme greed, most of your favorite stocks, their RSIs will be running hot. And if you see those RSIs anywhere close to 70, then you are looking at an eventual pullback. So that's when I like to go ahead and sell covered calls to take care of the call away before the stock retreats. Next, we're going to look at the NASDAQ, the QQQ, and I'm going to look at all of the variety of strategies, looking at where we are and share with you what may work best based on where we are trading. So if you look at this 3-month chart right here, we have our RSI and it's right here and it's at 47. So we're under 50. We had been riding high above 50. So we'll talk about that in a minute, but currently we're at 47 on the RSI. So with that being the case, if we are going to sell puts on the NASDAQ, you'd want to shoot right here for the bottom of the band. So you'd be looking at somewhere around that 590 area. Now, if you want to sell puts when this RSI is over 50, then more than likely we're going to be in this upper quadrant right here, and you'd want to look at shooting for the middle of the band. So that gives you a good guideline on whether that RSI is at 50 and above or below 50, where you might want to consider selling your puts if you're going to sell puts. Now, if you already have 100 shares of a stock, or in this case, the Qs, and you're looking to sell covered calls, typically you'd want to see this closer to 70, and you would want to see it at least maybe right here in the middle to the upper part of the band. And then for the fairest call away, you'd want to shoot to the top of the band, because once we get up here, if we are 70 on the RSI, then more than likely we will see a retreat in the coming weeks, and then you can regain your shares lower. This also works extremely well for the buy right. Anytime you see this RSI right here and we are slightly over 50, that means there's room to run, which is what you want with the buy right, because you're hoping that your shares do get called away because you want control of those funds to be able to take other trades with them. So if your RSI is over 50 and you want to buy 100 shares of a stock and then sell a covered call, it would work really well for you if you're right about here and then the momentum is building on a stock. When you are looking at doing credit spreads, ideally you would want the stock to be really kind of close to where we are now. We have to see if we get back over 50, but if we're really hanging out anywhere between about 48 and 52, that's a really good time to consider doing a 45-day credit spread. And if you want to build both sides, that should work well as long as we continue to trade sideways. But we have a lot of catalysts on the horizon that could spike or tank the market even this week. So I want to avoid anything like that until some of these macroeconomic events get settled. Now, if we're looking at skips or leaps, those are very popular. We just hit a very important trigger to buy leaps, and I called that out in my community, and it happened right here. We actually saw it happen, and I was able to almost nail it at the exact time that it did it. But it hit this 50-day moving average, and I was able to deploy some cash to go ahead and buy some leaps that expire well over a year from now. And then when we hit right here at the 20-day moving average, it's also a good time to do skips and leaps, but I don't go in as heavy at the 20-day as I would at the 50-day. So as the moving averages are going up with the number of days that are being considered, that's when I deploy more funds. For instance, I might do one skip and one leap at the 20-day moving average. Once we hit the 50-day moving average, that's when I might do 2 leaps and 2 skips. And then if we hit the 100-day moving average, I would maybe do 3 of them. And then if we get back down to this 200-day moving average or even below it like we were in April, that's when I would go ahead and deploy all of the available cash that I had planned for skips and leaps right here when we're at the 200 or slightly below it. I hope that opens your eyes to a variety of different ways that you can trade. Remember, if you're with me trading with Ashley, there is no trader left behind. Now, I hope to see some of you in the community this week as we kick off week 2 of the $50,000 retirement challenge. Talk soon.